really windy outside, eh?
It's the first thing you said while we're live. Hey, it's really windy outside.
It's really windy outside.
Hello, everybody who is joining us. We will give it a few minutes before we kick off today's very special webinar. What is today's webinar, Michael?
Windy outside. No, it's Investing 101.
Nice. Okay, we'll wait a couple of minutes and then crack into it.
I'll just hit you with some weather stats, storms blowing through, a bit of lightning.
So for those that are watching the recording, there will be a link in the description to jump onto Slido to ask some anonymous questions. You can ask some, for those that have joined us. If you're watching the recording and chuck down and ask questions on Slido, not going to be much use. Contact Michael directly. If you've joined us, check out the jump on Slido, use the live Q&A function to ask questions. There's also a link to our calendars to book a time to either talk to the mortgage team or the wealth team as well. While we're waiting a couple of minutes, Mike, I've turned off my iMessages and they're still coming through.
Cool. Do you want to put let Judy in as a panelist as well?
Yep. Hey Judy, we are already live, so we will. There you are, one last time.
Nice to see you again.
You too.
Yeah, I'm excited because this is actually the first one of your seminars that I haven't heard before. So
Ooh.
I'm going to be there taking some vicious notes and telling my husband that we've got to start all of our crypto properly.
Yeah, that's Mike's area of expertise. He's going to pay to mortgage the house, double mortgage the house, put it all into what's the new coin coming up, Mike?
I don't know, pick a name.
Yeah.
We're actually doing a podcast tomorrow with a lawyer who specializes in cryptocurrency.
Oh, really? We're from?
Yeah.
What agency are they at?
Is he at Simpson Grayson? Where is he from? Stace Hammond. Yeah.
Oh, nice.
And he literally wrote the legislation on cryptocurrency. So in terms of how New Zealand should deal with it from a tax perspective and those sort of things. So that should be good.
Oh, that'd be interesting. I'll log in and give it a listen.
Yeah. Cool.
Awesome.
All right. Judy's at 2 o'clock.
Amazing. So, hey guys, thank you for everyone who's joining us or listening to us separately. I know quite a lot of people have had various client meetings and things like that that have been booked in. So I'm sure there'll be a lot of you that are listening separately, but for everyone who's here, thank you so much. This is Investing 101, which I'm really excited about. As I was saying, I haven't actually been to the seminar before, so I'm looking forward to that. But I won't waste your time, so I know that you guys are here to see, not here to hear from me. So I'll hand over to you too. But thank you so much. It's been a really good few sessions. I really enjoyed them.
Awesome. Thank you very much, Judy. To the stars of the show. So today is the third session. Michael and I are quite emotional today. It is the last session we will be running with Waitapu Group for now. Today's session is Investing 101. Mondays was first home buyers. Yesterday's was paying down debt and growing your wealth. So today is all about, we're going to talk about cryptocurrency, investing principles, investment property, a whole range of different topics. Before we jump in, there are 2 ways you can ask questions. And Mike, we love questions, don't we?
We do.
So there are 2 ways to ask questions. One is in the description. There is Slido if you'd like to ask anonymously. Alternatively, you can use the YouTube live chat to ask questions, and we will tackle those at the end, ask them as we go. There's also a link to our calendar if you'd like to book a free 30-minute consultation to talk to the mortgage team, the insurance team, or the wealth team. A little bit about why you should listen to us before we jump into today's webinar. So at Lighthouse, we are a full financial services firm. Mike and I have over 20 years of experience with us. We also have a podcast and a YouTube channel that you can see that we're on today. So give that a subscribe if you're interested in hearing some of our great quality content and banter. At Lighthouse, pretty much we're all about securing your financial future, you taking control of your future and building the life that you've always dreamt of.
So the disclaimer. Now, for those who attended the other webinars, you might be looking at this and going, hey, this disclaimer seems a little bit beefed up. Because it's Investing 101 and people can make some rash decisions with their investing, we've decided to beef it up a little bit. So please take into account that this is not personalized advice today. Do not act on this advice without seeking personalized advice first, preferably from a professional. We are talking in general terms to provide information on investment options and investment principles. Again, this is not specific investment advice. I'm not going to tell you to sell the house and put it all on cryptocurrency or something like that. You need to be talking to a professional about your specific situation. If you would like to discuss your personal situation, though, we're happy to book a time with you to sit down and run through everything and give you the proper advice that you need.
And of course, it's fine to take Mike's advice on all crypto coins and go for gold immediately after this call.
Yeah, of course. So guys, our headline stat again, 46%. What is it? We know what this one is. This is the percentage of Kiwis who are unsure about their financial future or making a large financial decision. This is why we do these webinars. We want to improve this stat. 16 years. What is this? This is the time it will take your house price to double at a 5% growth rate. So if you follow the log function, in 16 years, all of the house price is going to double. And on average, we know that house prices grow around about 5% per year.
The log check to start us off with. Nice.
The max, yeah. 552%. What is this? This is the average house price growth. Well, it's not the average, it's the house price growth in Auckland over the last 20 years. That is an astonishing number. We'll run through property investment a little bit later in the webinar, just to talk through some of the ways you can capitalize on this. And 1.4 billion, that is the amount of money that went from growth funds to conservative funds in March 2020 when COVID hit. We quickly touched on this yesterday, but what that does is it crystallizes that loss. You take it out of the high risk fund, put it in the low risk fund, and instantly you've locked in those losses. So it's why it's always important to have professional advice when you are making these decisions.
Just on that point as well, Mike, I've literally spoken to people over the last 3 consecutive days who are worried about Ukraine and have moved from growth to conservative again. So I'm seeing it at the moment as well.
Yeah. Cool. So the agenda, guys, today's we're going to cover off some investing principles, a little bit around investment portfolios. I will cover off property investing, and we'll also talk about crypto investing as well. Now, crypto is a relatively new space in the investment sphere or the financial sphere. So we won't be giving detailed strategies on any of that. It's going to be more of an FYI and asking some questions about why you're investing and what you should be looking out for.
Okay, before we get into the nuts and bolts of different types of investment philosophy, first, we have to talk about the principles. And this comes to the age-old adage around, if I have some money to invest, what should I do? And the answer, of course, is always, it depends on you. Here are some investment principles that when we're working with a client to build a plan or work out the next step for themselves, we apply these principles every day to make sure clients are doing the right thing by themselves. So the first one is thinking about your goals. One of the big ones that I know Mike probably sees a lot on the mortgage side, maybe you can touch on in a second, Mike, is I've got all of my money for my first home deposit in cryptocurrency or in shares or in a high risk KiwiSaver, but they've got a short time frame to achieve their goals. So they've got the potential to end up with less money than what they thought they would have for their deposit, right, Mike?
Oh, absolutely. We see that really pretty frequently at the moment, and more so with KiwiSaver. People's KiwiSaver balances have dropped a little bit recently. So they're sort of saying, well, I had 60 grand, now I've only got 55 grand. So that can make a real impact, because if you're looking at a 10% deposit that you need, let's say that KiwiSaver was all of your deposit, you've gone from being able to borrow 600,000 to 550,000. So it's important to just match your goals, the time frame to the amount of risk that you've got.
Yeah, and you might be comfortable personally taking large amounts of risk, but your goals might not allow you to take that level of risk. So first you need to be thinking when you are investing, because at some point, unless you plan to bury yourself with the money or bury yourself with a house or your cold storage wallet, which you might do as a laugh, but you're going to use the money at some point to do something with it. And that is the goal. And the question becomes, is it short term or is it longer term? And that impacts what kind of investments you can look at. Linking very heavily to your goals is your time frame. So if you want to use it short term, you can't take as much risk. You can't tolerate the level of risk to achieve your goals. If you are 30 and investing for another 20 years, you got a lot of time. So it means you can probably take more calculated risks.
Yeah. And if we link that back to, again, a real life example of property, quite often we'll get people saying like, I want to buy a house in the next 12 months. Half of my deposit is in shares. The other half is in a high growth KiwiSaver. I'm sort of like, do those two line up? You know, what does that look like over the 12-month period with the risk you're taking on in the time frame?
Yeah. So with that third one around risk is, it's so important when you're making these investment decisions because there's different types of risk. If you are, and FOMO leads to people not really understanding their risks as well as they should. So you're buying an investment property, for example, but interest rates are going up. What is your risk around interest rates increasing? Can you service the debt at higher levels? What happens if the tenants aren't in the property for a period of time? Your KiwiSaver, it's not if it will drop in value, it's when it will drop in value. And any investment that gives you a good return, it's not if it drops, it's when it will drop. A growth KiwiSaver can drop 30%. We've seen cryptos halve in value. Some of them go even further than that. Direct investment into companies can go, you invest all of your money into A2 Milk. And if you've got some direct exposure like me, you're probably feeling the pain at the moment. Rocket Lab is another example of a recent company that's IPO'd and feeling the pain. So you need to be comfortable with what is not just thinking of the best case example, best case scenario where I end up with lots of money or my property is doubled in value. What are the risks? What are my worst case scenarios? When it comes to investment property, it's tenants not being there for a period of time. It's higher interest rates. It's what are my potential maintenance costs or all of those sort of things. When it comes to KiwiSavers, growth fund can drop 30%. Can I tolerate that? And being honest with yourself, Mike, it's very easy when you're sipping a cup of green tea and having a ginger nut, thinking, oh, yep, I can tolerate a 30% drop in my capital. But when it happens and you're down 30% and you don't know if you're at the bottom or not, it can be very difficult to hold. And you need to have an honest conversation about whether you can do that or not.
Yeah. And it's one thing for it to happen in theory. It's a different thing when you see the dollars disappearing on the screen. And the stats show it. We get a lot of people going from pulling out of investments, going from growth to conservative, selling at the wrong time.
Yeah. And a great example is like 3.5% of day traders on shares actually make money.
Yeah.
So, Sharesies and Invest Now and Hatch have done great things. But if you're investing in direct companies and just going with your gut and giving it a bit of a go, probably not the right thing to do. That final point, though, to help mitigate some of the risk is around diversification. If you have a well-diversified solution, there will be volatility, there will be periods with ups and downs, but you will always recover from those periods if you've got a well-diversified solution. So they're the first points. The next one is around trying to time the market. So if you think, let's start with property, because Mike, you'll be able to jump in with this one as well. Mike, How often do you hear, I think I'm going to wait 6 months until there's a property correction, and then I'm going to buy in at the bottom of the market?
Every day.
Yeah. How often does that work out for people?
Not too often. And it's funny, right? Because it's not just I hear it on both sides of the coin. As the property market's going up, people are like, no, it's overheated. I'm going to wait till it drops a little bit, that sort of thing. It then starts to drop, and I hear the exact same thing. No, I don't want to overpay. I'm just going to wait a little bit longer. I'm like, there is no perfect time to buy. And all we've done is wait 12 months, and you've missed out on capital gains inside that 12 months. It just, it's a little bit frustrating. I mean, we call it paralysis by analysis. But the other thing is trying to time the market doesn't work.
Yeah. So one of the big things when we set up a financial plan with a client is we're all about automating it, keeping it really simple, like you touch it once a year. And one of the big benefits from that is I don't care what happens in the short term. I care that over the other side of the world, there's conflict, and that's unfortunate, and people are suffering. That's not good. But from a financial perspective, in terms of the markets, unfortunately, the reality is there's going to be pandemics, there's going to be global financial crises, there's going to be conflicts, there's going to be some other thing that we've never seen of that will happen in the future. Every 5 to 7 years, something bad's going to happen, which is going to cause a market correction, and you are not smart enough to pick that correction. It is about going, what is the average I can get over time? I know in property, I can get a 5 or 6% return on average over a 10-year period. Shares will deliver me an 8% return on average over a period. There is a stat which is like, if you miss the top 10 days of the year in terms of the share market, your return goes from 8% to 4%. So if you pull out of the market and don't get those best days, you've halved your return. So don't try and work it out. Don't try and time the market. The world's never going to end. If your shares are down, just go buy more, buy the dip. If your property's gone down, your mortgage rates, your rent are all the same, just weather the storm. This is a really good example to prove that point. This is not Michael's heart rate after 2 mochas in the morning. This is the quarterly return of a 50-50 portfolio. So that's half in like shares and property, half in cash and bonds. Now, you tell me the trend here. You tell me when the right time to invest is. One good quarter does not mean another good quarter. One bad quarter does not mean one good quarter doesn't mean a bad quarter. One bad quarter doesn't mean a good quarter is what I meant. It's just impossible to pick. It's a bloody heart rate. This is something that you can pick. This is the S&P 500 rolling return over 30 years. So between an 8% and a 14% return rolling over that period is the law of averages over time going through long enough cycles. Even if you brought that into a 10-year period, it's going to deliver a pretty reliable outcome. But short-term, uncertain, long-term, much more peace of mind about your future and what the money can do for you. Speaking of portfolios and the like, the next question is, well, if you're not trying to time the market in terms of when to be in or out, then the question becomes, what should I be investing into? What is the hot take for this year? And this table graph, which looks a little bit complicated, shows from 2006 to 2020, the top performing asset versus the bottom performing asset. Once again, pick the trend. The answer is there's no trend. If you look at the AA in the middle, that is like a diversified portfolio. You can see it's always somewhere around the middle in terms of performance. That's where you're getting that peace of mind around average returns. Another great example is New Zealand shares dropped somewhere between 3 and 5% in 2021. The US share market went up about 20%. So it's just too hard to try and work these things out. You need well-diversified solutions over the long term. Otherwise, good luck being in that 3.5% that are successful day traders.
Yeah, and it's really tempting when you hear financial jargon to want to jump on board. Like if you look at that graph and you hear things like, oh, people are investing in emerging markets and this sort of thing, just look at the swing in the from year to year on that table of the emerging market stuff. It is literally at the top and then the bottom, then the top and then the bottom. So again, very difficult to pick which specific area to invest in.
Yeah, so this comes to the point around being well diversified. So we build at Lighthouse our own investment portfolios for clients, and these are the 4 assets that we're using. So if you're more conservative, have a shorter time frame, more defensive, you're probably going to have more cash and bonds in your portfolio, not going to knock your socks off in terms of return, but provide stability, make sure the lows are less low. Then you might have either investment property, commercial property, industrial property in your portfolio, and then shares in Australia and New Zealand and the rest of the world. Now, if you're trying to invest, there's lots of different ways you can do it. Obviously, there's the rise of the direct investing platforms. There's those who might go, I'm not going to pay someone else when I feel comfortable investing myself. If you want to manage your own sort of portfolio, especially if you've got maybe a bit of a lower balance, a Sharesies or a Hatch or an Invest Now could be great. If you're feeling like you're gambling, you don't really know what you're doing, then maybe you want to look at one of the other options. So like a Simplicity or a Kernel, they're what we call passive investing. So they keep their fees really low, but they'll only perform whatever the market does. So if the market does 8% and they charge a 0.3% fee, your return's going to be 7.7% before tax. Then maybe you have a more active investment approach. You might have a financial advisor in here from Forsyth Barr, Craig's, or maybe Milford. You got to be careful here around the fees. The fees might be quite high. At Lighthouse with our solutions, we try and do a bit of a blend between active and passive, and then providing the service over the top. All of these solutions could be the right thing for you, but you've just got to all have pros and cons, and you need to decide which one might be right for you.
Yeah. And again, it really is going to come down which one is right for you. We also have, some of our clients who invest seed money in startups, and that is the ultimate long shot. It's not liquid. There's a high chance that the whole thing will fall over. They can't get any sort of returns for a number of years, but they're comfortable with losing that money if it just goes to zero, and they accept that risk and they build that into their financial plan. So these are the sorts of things you just need to consider when picking what avenue you're going to invest in. Right, property investing, the Kiwi obsession. So what I'm going to do is run through a really quick sort of roadmap from what a typical investor looks like, because it's one thing to sort of hear, hey, people have 10 houses, 20 houses, everyone's got an investment property, but it's nothing to how you actually do it. So when you buy your first property, typically you're going to have sort of between 10 and 20% deposit. That property, if you are looking at it as an investment, and most people it's an owner-occupied property, but if you are looking at it as from an investment perspective as well, it's going to be a capital gains focused property. And what I mean by that is it's going to be a type of property that will move up with the market or in line with the market as it increases. For most people, to get a little bit more capital gain out of it, and with their first property, you have the ability to renovate the house. You might buy the worst house on the best street, add value to it, and then 1 + 1 = 3 instead of 2. So the money that you spend on it will get you more capital gains out of those property. For some people who want to get on the property ladder sooner rather than later, you can actually buy an investment property as your first property, but just keep in mind that you can't use KiwiSaver for that. So you will forego that if you buy an investment property as your first house. So once you've purchased that first property, you've been paying down the mortgage for a few years. The market has continued to increase. So let's call it 3, 4, 5 years. You'll have some more equity or usable equity in that property. So that's when people leverage up using the equity in their first property to purchase a second property. Now, that property is usually cash flow focused. And for a lot of investors these days, that's a new build property. So they're buying off plans and they'll buy the house today, get the house in 12 months. You don't pay anything, or you pay a 10% deposit, and then you don't pay anything until you actually get the house and it's completed. The reason new builds are really popular at the moment is you can buy them with as little as 10% deposit. If you buy an in situ existing house, you're going to need a 40% deposit or equity. So you're going to need a lot more equity in that original property. So people purchase a new build property. It's a townhouse somewhere close to a city center. You're not paying for land, you're paying for the house, and then it'll rent itself out. Because if you get an in-situ property, more land, you're paying for the land, you can't really rent that land out. Another couple of advantages of new builds, 5-year bright line, so that's around the tax that you pay when you sell it, and interest is a deductible expense on these properties where it's not on an in-situ property. You should be speaking to an accountant about this, about the structure of the ownership of the borrowing and of the property if you're looking at purchasing an investment property. So once people have their first house, they then usually buy that new build investment property, cash flow focused. They can then split out to looking at a property portfolio. So when you're looking at a property portfolio, so 2 investment properties, 3 investment properties, so up to 5 or 6 investment properties, you start to get a mix of cash flow focused and capital gains focused properties in there. Now, to do this, you usually need to start to split your banking out. So you might have your owner-occupied property at, say, Westpac, and then your investment properties between ANZ and ASB, or maybe ASB and a second-tier lender, like, for example, a Resimac or a CFML. The reason you do this is so that you can borrow or continue to borrow, and you don't cap out on one bank's credit policy, so you can continue to add to the investment portfolio over time. You should be looking to diversify across regions. You'll have a bit of time, so you can look for bargains in the market. They are still out there. You don't need to just continually purchase straight away. You should look to utilize revolving credit facilities for deposits or offset loans. These are a little bit more efficient on the tax side of things. But effectively, what you want to do is spread over regions, spread over banks, and look for that mix of properties in that portfolio as well to try and give you a fairly consistent return.
Mike, can I just ask a question or a train of thought that I hear people using all the time?
Yeah.
And just keen to, I did this myself as well, so go easy if the answer is no. I bought my first home. I want to upgrade my home. I think I should leave the house I live in at the moment as an investment property.
Yep.
Generally speaking, I mean, obviously it probably depends on a few factors. What are the pros and cons of that kind of strategy?
The pro is you already own the house. You know what it's like. You're not rolling the dice on a new property. You know reasonably that it's okay. The foundation's okay. The roof's okay. It's not going to fall over tomorrow. I guess the other pro is you've already got it as a security, so the bank knows it as a security. The con is probably that it will be classed as an in-situ property, so you'll need a 40% deposit. So you are potentially better to buy a new build investment property, separate that out into another bank, and then you can sell and recycle your house and upgrade.
And that 20% for new builds versus 40% for an existing house, it can make a huge difference to people whether they can do something or can't do something, right?
Oh, we'll think about it on a new build, on $1 million property, right? If it's an in-situ property, you'll need a $400,000 deposit or $400,000 of usable equity in your existing property. If it's a new build property, you can get it down to 10%. You might only need $100,000 of equity or a deposit. So yeah, the difference is night and day between the two. But again, depending on what you're looking at and how much equity and how much deposit you have, neither one is better or worse. You're just focusing on different returns that you want. Either you want the cash flow. So, these new build townhouses close to a city centre, they'll be rented out by young professionals. You can get a little bit more rent out of them. If you get an in-situ large property with land, you're likely to get a family in there. There'll be longer term tenants, but you won't be able to sort of charge them as much rent. So it just depends on what you want. The other thing that people quite often talk about is whether or not they should go commercial. It is a completely different kettle of fish. Commercial lending is different. Loan terms are different. Interest rates are different. It's all on a risk-adjusted basis. The upfront rent might look better, but the risk is completely different. The returns are completely different. Returns in commercial property are not generic across the board like they are with residential property. You then start looking at this type of property or type of commercial property. Like warehouses have gone absolutely crazy over the last 2 years because of supply chain pressures. But retail storefronts, even in city centres, are performing very badly because of the pressure on retail shops. So it is a totally different kettle of fish when you look at commercial to residential. So for early investors, we always sort of point them towards residential.
Cool.
So a couple of other points on property types. These are the three major types of property that you will invest in as a residential property investor. Each of them have their pluses and minuses. They're just different. None is really better or worse depending on your situation. Apartments. So generally they are the cheapest option because they're usually not a grounded security. You don't own the land underneath it. You own a share of the whole building. Usually cheapest. Look out for the body corp fees because you might see a really good deal, but then it might be $6,000-7,000 a year in body corp fees that you have to pay. You're going to get less capital gain off these properties. Again, you don't own all of the land underneath the apartment, so the capital gains just aren't there. They'll be in a good location though. City center, these sorts of things. You're going to get short-term tenants in there, probably the shortest of all three types. But just look out for the size restrictions. If it's under 50 squares, you're going to start running into trouble getting 80% lending against these properties or 90% lending. You're going to be around that sort of 60 to 70%. So there's a little bit to watch out in the apartment space. They haven't been performing too well recently. Obviously, especially in the major centers because people aren't living there so much anymore. Townhouses, sort of next step on the ladder, a really good entry-level option, usually a new build. They'll be close to a city center. A good one should be by good public transport, somewhere where people want to live or an up-and-coming area. They'll be low maintenance because you don't have all the land that you have with a sort of a standard Kiwi, quarter-acre house. There will be some body corp fees or a resident society fee, but it'll be a lot lower than an apartment usually. You'll get short to medium term tenants. So think young professionals who are saving up for their own house. And because a lot of them are new builds off plan, you can get it with as little as 10% deposit, which is a huge plus when you're looking for investment properties. So houses, the classic quarter acre Kiwi dream. These are going to be the most expensive because you've got the most land underneath. Some of them have the ability to add value, which can be a really good thing if you're DIY inclined or you want to sort of cash flow hack the property. They might be a little bit further out from the city centre, depending on what you can afford. But you will get, again, like I sort of said before, longer term tenants. Those would be more sort of family focused, but you'll command a little bit less rent than you probably would out of the similar sized townhouse. You'll get more land with the house, which effectively means more capital gains. But just be careful here because if you get something with enough land, you will be starting to scrap with developers when you go to the auction. And it's likely that you might do due diligence on the property, waste a bit of money, and you'll get beaten at the auction.
Couple of questions there, Mike. Apartments, let's be honest, let's cut the BS, let's get to the point.
Okay.
Are they ever a good investment?
Yes, they are.
When?
They're a good investment if they are close to a city centre, if COVID never happened, if we still had probably a lot of international students in the city, because they used to be pretty easy to rent out. They don't give you the same capital gains, and they've performed pretty badly because of what's been going on in the world. But they're not a bad investment. They're probably just not as good as townhouses and houses on a capital gain perspective. But again, you might find a really good apartment that has a long-term tenant, and the rent covers the mortgage, and they'll pay it down. Okay,
and townhouses.
Yeah.
Or like you've referred to new builds, I should say, quite a few times.
Mm-hmm.
They're very popular at the moment. The government's trying to incentivize people to invest in them. Are all developers the same? Is it all much of a muchness, or how do I pick one?
No, that's something I can categorically answer. Not all developers are the same, especially in this market. So at the moment, there is really heavy pressure on the supply chain for building materials in New Zealand. And if you think about, let's say I'm Fletcher Construction, or I'm the person who imports the building materials, who am I going to give the short supply of building materials that I have? Who am I going to give that to? Am I going to give it to the likes of GJ Gardners and Williams Corporation, who spend 70, 80 mil a quarter with me? Or am I going to give it to the one-time developer who's doing a 4-house townhouse development on a block of land that he owns? You know, some of the smaller developers are really struggling for materials at the moment, and you're seeing that in the delays that it's taking to get it built, the quality. They're subbing in, you know, different materials and this sort of stuff. So at the moment, it pays to go with a big developer. They'll have access to the materials. You're more likely to get the house that you paid for in the time frame that you expect it. And we have some pretty bad horror stories for some of our clients who've gone with less reputable or smaller developers. Like someone ripped down, you know, got frustrated, stole a digger on the site and ripped down half of the development. We've had people who, we've had security guards set up a smoker room in their house before it was even finished. You know, just a lot of sort of, you know, horror stories like that with some of the smaller developers.
Nice. Mike, I'm a little bit, you know, I don't want to say disappointed, but I'd love to see some more questions. So we've got one question, which is probably a timely time to remind people to put questions in Slido or the Q&A function on YouTube. And I'll ask you one question, Mike, because it's very relevant to where we are in the presentation.
Yep.
Why are land lease properties so cheap? Are these a good investment?
Oh, leasehold properties?
Yeah.
Because you don't own the land underneath it. You're renting it off someone else who owns it. I'm not going to, actually, you know what? Stuff it. I'm not going to sit on the fence here. They're a terrible option.
Tell it as it is, Mike.
Yeah, I'm going to. No, they're not a good investment. Look, they may appear to be cheaper up front, but you're not going to get the capital gains off them, because the more that, well, generally speaking, the more that lease runs out, the closer you are to the end of the lease term, you inevitably end up having to renew the lease with the person who owns the land underneath the house that you own on top of that land. That's not a, hey, I think it's 10 million per year, you think it's 10 million per year, kumbaya. That's a scrap that goes to court. You know, and that just gets divvied up between all the leasehold owners, and you have to pay those costs. Yeah, we've seen that time and time again. We have an example of one of our customers who had a leasehold property in Newmarket, and the person who owned the ground lease underneath them, and this is their owner occupied property, just said, you know, hey, look, we're gonna sell all of the land at the end of this lease. And we'll pay you $65,000 for the house that you paid, I don't know, $700,000 for, and thanks very much. They never sold it. They went to court, evicted them, ended up not selling the land and redeveloped it and kept it for themselves. They are not a great investment. They're, you know, it gets messy.
100% agree.
Cool. So over the different property types, what does this sort of look like? Now, we've got houses, units, and apartments here, Auckland and Wellington for 20 years, 2001 to 2021. It's a very clear trend, right? So houses, you know, around that sort of 550% mark over the last 20 years in capital gains. Units tracking pretty close behind. But if you think about that unit or that townhouse, the price difference there still makes these a pretty good investment. And apartments, you're not getting the same capital gains out of these properties. This is more of a cash flow focused property. You're going to be getting reasonable rent compared to the amount that you've purchased the house for. We call that the gross yield. It's a pretty good gross yield off it, which means you'll be able to cover that mortgage. So you're not going to get the capital gain, but someone will be paying that mortgage down for you.
Yeah, I mean, coming back to that point around, are apartments a good investment, Mike? You look at this and you go, they must have really good rental yields to justify them, right?
Yeah, absolutely. And some of them won't have really good rental yields at the moment in the market because rents have been lagging a little bit behind house price growth. But, you know, it's just a different type of property that you're putting into your portfolio. It's not good or bad. It's bad, obviously, if you're focusing on capital gains, but if you're focusing on yield or cash flow, it might be a lot better. So, is residential property the best asset for retirement? Look, Kiwis are obsessed with investment properties, or just properties in general, to be honest. People will load up their portfolio and carry it right through to retirement and think, yep, look, I've got all these assets and it's going to do me well. investment properties are not liquid assets. It takes a fair amount of time and cost to sell a house to get the money out of it. And let's say you want to go on holiday because you're retired. You can't sell a bathroom or half a house to get some of the money out to go on holiday. You need to sell the entire property at one time. So you want to make sure you've got a mix of assets in your portfolio. And as you're moving into retirement, some more liquid assets that you can draw down on. So draw down partial bits of funds. So you're not having to sell something just to get a little bit of money out of it.
Yeah, I have this discussion often, Mike, when we're talking about managed funds versus investment properties. And I do lose the discussion quite a bit because of the emotional attachment or the comfortability with property historically. If you keep property in retirement, you will get, and assuming that you've got debt-free investment property, which is a pretty big assumption to have, the rent after all costs and then after tax is depressing. And it's about thinking about the lifestyle you want in retirement. So you're going to have a lot of properties to give yourself $100,000 income or very specific types of property, opposed to a managed fund. You might start with, I don't know, say $1 million, spend the return, spend the capital, and by the time you're 90, have $300,000 that have a hell of a good time and some memories at the end of it.
Yeah. So crypto investing. Now, I'm going to start this with a bit of a disclaimer again. If you're asking me what cryptocurrency is and why you should invest in it, you probably shouldn't be investing in cryptocurrency. Financial asset or, sort of fairly new player in the investment market. It's not completely regulated yet. There are a lot of scams out there and things you should look out for. So what I'm going to give you now is an overview of it. And I guess just some things to watch out for when you are investing in crypto. So what is it? Look, it's a decentralized token or an asset that can be used as a store of value or to exchange for goods. Generally speaking, most people know what they are. They're based on blockchains, which are sort of ledgers that everyone has that sort of represent ownership stakes in the coins. Now, many of the features that are available in traditional investment products are available in crypto. So you can leverage these assets. You can earn interest on them. They are fairly liquid. You can move in and out of them. But just keep in mind that there are transaction costs. So look out for the gas fees on this if you are sort of switching crypto fairly regularly or spending them. They are pretty volatile. So this is a recent track of the Bitcoin price, I guess from 2020 to today, starting at 11,000, going up to 63, then down to 30, and today we're sitting at 42. These things move around a lot. Look, volatility does create opportunity, but again, it means that your investment can go from $63,000 to $30,000 pretty quickly. They're quite, unstable, and some of the smaller coins again are going to be far more volatile than some of the bigger ones. But again, we don't have a long history of these coins to be able to give you averages really, or meaningful averages. So if you do want to invest in cryptocurrency, what should you be thinking about? There's a lot of things to sort of consider. First up, look at the merchant or the exchange that's facilitating the transaction. You want to use something with a bit of size and scale. Coinbase, Binance, these sorts of guys. But again, that doesn't always mean that it's going to be safe as well. Some of the larger ones, I think Binance at the moment, or is it Coinbase or Binance, is under investigation at the moment by the SEC. So just because they are the largest player in the market doesn't necessarily mean that they're safe. So do due diligence on the merchants or the exchanges that you're using. So think about the storage facilities as well. So if you're using a hot wallet or online storage, a lot less secure than cold storage, a lot more convenient. But you might be using something like MetaMask or the Coinbase wallet as well. So yeah, convenient. You can move in and out pretty easily, but again, less secure. And then if you start to look at the most secure sort of method, that cold storage, so something like Ledger, a cold storage sort of wallet. Again, though, these aren't always secure as well. There's a fairly well-known case in Auckland where someone was renovating their house and had left their cold storage wallet in the safe in their house. That safe got stolen, and along with it went all of their cryptocurrency. So they're trying to broker a deal to get, or they were trying to broker a deal to get that back. So just think about the logistics and the security of what you're doing if you are investing in these. So I know this looks like a pyramid. I know it's not a pyramid scheme, but there are some fairly frequent stories of people getting ripped off in this space. There are a lot of sort of scams and things like that going on. If that altcoin, IPO sounds too good to be true, sometimes it usually is that you see a pump and dump in that space quite a bit. The social engineering here is completely rife in this space, especially with NFTs as well. So just think about who you're buying off, what you're buying, how you're buying it. I can keep going through a lot of these, DeFi rug pulls, again, those are initial coin offerings, but the big one at the top, like I sort of said in the previous slide, just because an exchange is large doesn't make it safe. Mt. Gox used to be, one of the largest or the largest exchange and storage platforms. It stands for Magic the Gathering Online Exchange. It was originally built for people who play Magic, the card game, to sort of trade things. Think about what you're putting your money and your assets in, not just going for the biggest player in the market, but doing some due diligence and thinking about the security behind it. The big one, why are you investing in cryptocurrency? Is it because you have fear of missing out? Is it because it's a hot thing to invest in? Or do you fundamentally believe in the coin, the blockchain, the technology, or the story that this sort of, coin is telling? It's going to come down to the fundamentals here. You need to consider the why. Don't just jump in there because everyone else is. It may not be the best asset for you. Disclaimer, both James and I own cryptocurrency. I should have given that at the start.
Cool. So KiwiSaver, I'm just looking at the time. I'll just touch on really quickly. So for the average person, KiwiSaver will be one of your biggest assets come retirement. So it's important you're making an active choice with the contribution level, the type of fund, which we spoke about from a risk perspective before, timeframe, goals, low risk to high risk, and bloody hell, pick a provider. Like these people are managing your money, they're making money off you. Just, decide whether you want your bank, decide whether you want Simplicity, something more ethical, Milford. Just make an active choice. If you need any help making that decision, that's something we can help you with. There's also lots of great online tools like sorted.org.nz. Here is an example of just how big of a range this can have. So I know there's no 20-year-olds earning $80,000, but it might be an average income for this person over their life. So you can see the contribution level and the fund can make a really big difference come retirement. So a smaller contribution and a more defensive fund might be appropriate for you for a wide range of reasons. Aggressive might not be appropriate for you because of your time frame or your attitude to risk, but it's important you make an active decision with one of your biggest assets come retirement.
So some key points from today. Think about the investment strategy. Look, guys, this should align with your goals, your time frame, and your tolerance for risk, but do not ignore diversification. I know it's tempting to throw everything into one too good to be true investment. Usually when we do this webinar, we get the question around what's the next, hot stock pick or something like that. Guys, it's about diversification to reduce that risk. If you're investing in property, think about the type of property you invest in. Pick your property type wisely. Think about, we talked about apartments, new build townhouses or just townhouses, and also just in situ properties. We also touched on commercial as well, probably not for a first-time investor, but just think about the type of property you're investing in. Invest for your stage of life. If you are completely leveraged up to the eyeballs of property moving into retirement, you probably need to reconsider your mix of assets in your investment portfolio. Again, you can't sell a bedroom to go on a holiday. Invest for the right reasons. Guys, we touched on it with cryptocurrency, but it applies across all investments. Is this a long shot Hail Mary that you're investing in? If so, might be better to buy a lotto ticket. Just invest for the fundamentals. Think about long-term assets, long-term returns, long-term averages, not looking for that get rich quick scheme. And then, of course, if wealth is like a snowball, get rich quick schemes are like an avalanche. We touched on it about 10 times yesterday. Small, consistent steps over time build wealth.
So if you need help taking the next step, in the description of this video, there are links to talk to one of the mortgage team at Lighthouse for a free 30-minute consultation. Talk about your situation, talk about your goals. Mike's job is to get people money, see if he can get you some money. There's also a link to talk to our insurance team if you want to review your life, income, or health insurance. And finally, if you want to talk about investing, if you want to talk about your financial plan, if you want to talk about your KiwiSaver, you can also book a time. So if you've got what you wanted out of today's session, that's great. If you'd like to have a chat to us one-on-one, we'd love to talk to you. And then, of course, there is heaps of information on this channel. There's over 80 videos. Make sure to subscribe. Make sure to come back and have a look in the future. More information helps you take control of your future, achieve the lifestyle that you're trying to work towards. All right, Mikey, it is question time. Now, I can see one question on Slido. And then if there's any in the live chat function as well, we do not have many. So this will wrap up very quickly if we do not hear many. Mike, here's one for you. When do you think NZ will have a regulated digital currency?
I have absolutely no idea. I don't think anyone can answer that. What I would say probably though, is I'm happy to ask the person we're doing a podcast with tomorrow that question. We're doing a podcast tomorrow. We're filming it actually with a solicitor who actually helped to write the legislation on cryptocurrency in New Zealand. So I can't answer it, but I'm happy to take that one away and ask him, and we'll get it in the podcast for you.
Cool. Nice. Yeah, I think that's a good one. Do any countries have regulated digital currencies yet?
I'm not too sure, mate. I'd have to ask. I have to ask tomorrow on the podcast. Yeah.
Yeah, I don't think so, but I could be wrong.
There are some other questions in Slido. So we answered the one on leasehold properties. Why are they so cheap? Again, you only own the house on the top of the land. You are renting the right to be on that land off the person who owns the land underneath. We've got another question in there. What % deposit do I need for an investment property? It depends on the property type. So if you're buying a new build property, so a property that hasn't been completed yet, you're buying off plans, or has recently been completed and you're buying off the developer or the person who built it, and no one has lived in that property, I know it's a mouthful, you can buy it with as little as 10% deposit. If you are buying an in situ existing investment property, you will need a 40% deposit. Where some people get caught out here is they think they're getting a good deal when they're buying a property they think is a new build, but they're not buying it off the developer. Someone else has bought it in between buying it off the developer and off the and selling it to them. So actually, it's not classed as a new build from the bank's perspective, and they end up needing 40% once they've signed the contract. So just be careful about that. But new build properties, 10 to 20%, in situ properties, 40%. It's a little bit left of center, but commercial properties, probably around that 35, 40% mark as well.
Nice. Okay, I think we're out of questions, Mike.
Cool.
We will wrap it up there. Thank you very much for everybody who's joined us. Some great questions in there. Look forward to talking to some of you one-on-one in the future.